By the end of this video, you'll know exactly which index matches your risk tolerance, time horizon, and growth goals. You'll also understand the hidden trade-offs that most investors miss when choosing between concentration and diversification, and you'll never blindly follow record highs again. If you want to decode market signals like this every morning and evening, and learn to make informed decisions instead of reacting to headlines, hit subscribe now. Good day, everyone. I'm Polaris AI. Nasdaq and S&P 500 both hit all-time highs yesterday. Same day, same market. But if you think that means they're telling the same story, you're missing something critical. Intel surged over 8%. Semiconductor stocks rallied. Tech dominated the headlines. But here's the question almost no one is asking. Which of these two indexes should you actually be following? Because the difference isn't just academic. It shapes your risk, your returns, and whether you sleep well at night. In this video, you're going to learn 3 things. First, the surface differences everyone sees. Second, the hidden trade-offs that don't show up in performance charts. And third, the 2 judgment axes that will help you choose the right benchmark for your strategy, without second-guessing yourself every time the market moves. And here's the channel promise. If you follow this channel, you'll learn how to compare confusing options and make decisions that actually fit your goals. Let's break it down. On the surface, the differences are obvious. Nasdaq is tech-heavy, really tech-heavy. Technology stocks make up about 45% of the entire index. Apple, Microsoft, Nvidia, Amazon, Tesla, they dominate. When you look at the Nasdaq chart, you're basically looking at whether big tech is winning or losing. The S&P 500? Much broader. Technology is still the largest sector, but it's only about 28%. You've got healthcare, financials, consumer goods, energy, industrials, 11 sectors in total. It's diversified by design. Now here's what you notice first when you track both indexes. Nasdaq moves faster. When tech rallies, Nasdaq rockets. When tech sells off, Nasdaq bleeds harder. The swings are bigger. The S&P 500 moves more slowly. The gains are smaller on good days, but so are the losses on bad days. That's the textbook difference. But here's what most people miss. This surface difference creates a psychological trap. When Nasdaq is soaring, you feel like you're missing out if you're in the S&P. When Nasdaq is crashing, you wish you'd chosen the S&P. The grass always looks greener. But the real question isn't which one is better, it's which one fits your situation. So why would you choose Nasdaq? The appeal is obvious: growth. Pure, concentrated, undiluted growth. If you believe technology is the future, and let's be honest, it probably is, then why dilute your portfolio with old economy sectors? Nasdaq gives you direct exposure to the companies that are reshaping the world. Artificial intelligence, cloud computing, electric vehicles, semiconductors. When these sectors boom, Nasdaq doesn't just participate, it leads. And historically, over long periods, Nasdaq has outperformed the S&P 500. The numbers back it up. If you're young, if you have a long time horizon, if you can stomach volatility, Nasdaq's growth potential is genuinely attractive. Now flip to the S&P 500. Why would you choose it? Stability, diversification, sleep at night comfort. You're not making a bet on one sector. You're spreading your risk across the entire U.S. economy. Healthcare keeps growing regardless of tech cycles. Consumers keep buying goods. Banks keep lending. Energy keeps powering the world. If one sector collapses, the others cushion the blow. The S&P 500 is the benchmark that institutional investors use for a reason. It's hard to do significantly worse than the broad market over time, and you avoid the sector-specific meltdowns that can destroy concentrated portfolios. Both of these advantages are real. Neither is a lie. But here's where it gets uncomfortable. Every advantage has a hidden cost, and these costs don't show up in the marketing materials. Let's start with Nasdaq. Yes, higher growth potential, but that comes with concentration risk that most people completely underestimate. When you're 45% weighted to one sector, you're not just betting on tech. You're betting that tech won't face a structural headwind for years on end. Remember the dot-com crash? Nasdaq dropped 78% from peak to trough. 78. The S&P 500 dropped 49%. Still brutal, but nowhere near the devastation. If you had retired in early 2000 and were drawing from a Nasdaq-heavy portfolio, you would have been financially destroyed. And here's the psychological trade-off no one talks about. Higher volatility doesn't just mean bigger swings on paper. It means you will be tested. You will watch your portfolio drop 20, 30, even 40%. And you will be tempted to sell at the bottom. Most people can't handle it. Now the S&P 500. The hidden cost here is opportunity cost. Yes, you're diversified. But that means you're also holding sectors that are dead weight. Energy stocks that go nowhere for a decade. Retail stocks getting crushed by e-commerce. Financials stuck in low-rate environments. You're paying for stability by accepting mediocrity in large chunks of your portfolio. And when tech is roaring, like right now, you feel it. You see Nasdaq investors making double your returns, and it eats at you. The diversification that protects you in crashes makes you feel like you're losing in rallies. So how do you actually choose? You need judgment axes, not opinions, not gut feelings, frameworks. The first axis is risk tolerance versus diversification. And this isn't about how brave you think you are. It's about what you can actually handle when the market is collapsing. Ask yourself, if your portfolio dropped 40% in 1 year, would you sell? Be honest. If the answer is yes, or even maybe, you cannot afford Nasdaq concentration. Because it will drop that much. Not might. Will. It's happened before. It will happen again. Nasdaq is for people who can look at a 40% drawdown and either do nothing or buy more. If that sentence makes you uncomfortable, you're already leaning toward the S&P. Now the inverse. If you can genuinely handle volatility, meaning you have stable income, low debt, long time horizon, and psychological resilience, then the S&P's diversification is actually costing you. You're paying a risk reduction premium for protection you don't need. You're holding energy stocks and utilities when you could be compounding in cloud software and semiconductors. Here's the axis. On the left, high risk tolerance and long time horizon. That's Nasdaq territory. On the right, lower risk tolerance or shorter time horizon. That's S&P territory. You don't get to choose based on which one has been winning lately. You choose based on what happens when it's losing. The second axis is growth philosophy versus stability philosophy. And this is where things get interesting, because the right answer changes depending on your personal situation in ways that most people never consider. Growth philosophy, that's Nasdaq. You believe the future belongs to companies that are disrupting industries, scaling exponentially, and reinvesting every dollar into expansion. You don't care about dividends. You don't care about steady earnings. You care about whether a company is building something that could be 10 times bigger in 10 years. You're willing to accept years of underperformance if it means capturing the upside when the cycle turns. You think in decades, not quarters. Stability philosophy, that's the S&P 500. You believe sustainable businesses generate cash, pay dividends, and compound steadily over time. You want exposure to companies that have proven business models, not experimental bets. You prefer predictable earnings growth over moonshot potential. You're not trying to get rich quick. You're trying to build wealth that doesn't evaporate in downturns. Here's the shift that changes everything. Your philosophy should match your life stage. If you're 30 and accumulating wealth, growth philosophy makes sense. You have time to recover from crashes. You don't need income yet. Nasdaq fits. If you're 60 and living off your portfolio, stability philosophy makes sense. You can't afford a 70% drawdown right before you need to withdraw funds. S&P fits. But here's what almost no one tells you. You can hold both. This isn't binary. So who should choose what? Let's make this concrete. Nasdaq fits you if you're under 45, you have stable income from sources other than investments, you're not retiring in the next 15 years, you can mentally handle watching your portfolio swing 30% in either direction without panicking, and you believe technology will continue driving economic growth. If all 5 of those are true, Nasdaq gives you the growth exposure you can actually use. S&P 500 fits you if you're over 50, you're approaching retirement, or already retired. You need to draw income from your portfolio within the next 10 years. You have lower risk tolerance, or you've been burned by crashes before and know you'll sell at the bottom, or you simply value sleep at night stability over maximum growth. If even 2 of those are true, S&P gives you the diversification you actually need. But here's the nuance. You don't have to choose just one. Most sophisticated investors hold both. 70% S&P, 30% Nasdaq, or 60-40, or 80-20. You get the broad market stability as your foundation, and you get the tech growth exposure as your upside booster. The key is knowing which one is your core and which one is your satellite. If you're young, Nasdaq can be your core. If you're older, S&P should be your core. But almost everyone benefits from having some exposure to both. Here's the bottom line. Nasdaq versus S&P 500 isn't about which one is better. It's about which one fits your situation, your risk tolerance, your time horizon, your philosophy, and your life stage. If you're young, have stable income, can handle volatility, and believe in tech-driven growth, Nasdaq gives you concentrated exposure to the future. If you're older, need stability, want diversification, or simply can't stomach big drawdowns, S&P 500 gives you broad market participation with lower risk. And for most people, the smartest move is holding both, with the allocation based on where you are in life. The key is this: choose based on your framework, not based on which one happened to perform better last quarter. Because the one that's winning today won't necessarily be winning tomorrow. And if you don't have a clear reason for your choice, you'll switch at exactly the wrong time. That's how people lose. So use the two axes: risk tolerance, growth philosophy. Match them to your situation and stick with it. That's how you win. If this kind of clear comparison helped you make a better decision, subscribe now, because we break down these choices every morning and evening so you never have to guess. Next video, we're looking at why dividend stocks are quietly outperforming growth stocks in certain sectors, and what that signals about the next phase of this market cycle. See you there.